And I don't know if it's a premonition. I don't know if it's wishful thinking. I don't know what it is, but there's just this overwhelming feeling that I have that they're going to sacrifice Bank of America. They're going to let Bank of America fail. Yeah, I mean, 100%. It's 100%. All of these banks are systemically tied together. Why did Credit Suisse have to get bought out by UBS? Because it was systemic. And we have a situation where the banks are over leveraged and undercapitalized. And I don't know if it's a premonition. I don't know if it's wishful thinking. I don't know what it is, but there's just this overwhelming feeling that I have that they're going to sacrifice Bank of America. They're going to let Bank of America fail. Maybe that's why Warren is doing what he's doing by yanking all of his shares, not all of them, but a good portion of them. And this is the bank that has to be bleeding massively from their large short position in both gold and silver. Whether it's Bank of America or another major bank, I think the systemic nature of the banking system, and in particular the large commercial banks, is real. It should not be understated. The world itself is quite systemic right now. So the systemic risk in the bond market, where the bond market in and of itself is systemic just because it underpins so many other industries, like the insurance industry and even like the banking industry. And, we're going the wrong way by lowering rates, at least on the front end of the curve. So what does that do to the back end of the curve? But you end up with a situation where this is a problem for funding our deficits. Ultimately, rates must go higher. So here we are again, lowering rates and perhaps setting up these institutions to load up on treasuries, only ultimately to see rates go the other way, because at some point you have to fairly compensate people for taking on all of this risk that the central banks are illuminating here, the default risk, the systemic risk, the inflation risk, and the de-dollarization risk. So, yeah, I think systemic risk, and we've talked a lot about systemic risk, is something that will. It's the same way of saying counterparty risk. Counterparty risk is accentuated because of the systemic nature of everything. The domino right in front of you may not be the bad one, but it could be the 1, 2, or 3 behind you that you don't even see. Quite frankly, I'm surprised that we haven't seen a domino fall yet. If the government wants to move towards consolidating the banks, which I think they do, and I know Lael Brainerd does, to issue a CBDC perhaps soon, then I think you have to ignite that fuse. And what better way to ignite the fuse than to let a major player fail, inciting a bail-in, initiating a bail-in, which then really creates systemic risk as people in this country wake up to what a bail-in is and the ramifications of that, the consequences of that, as people run to yank their money out of all of the other banks, which creates more systemic problems in nature. It's real and might be the one thing that we are underestimating totally as to the real problem with the system. Well, and look, the guy is the greatest value investor of all time, and he doesn't see value. That's the bottom line. And maybe he sees much more than that. Maybe he sees risk. But I just have a feeling that there will be a problem with the banks that ignites the systemic problem. And look, more than anything, the central banks, done again, they may have the most money, but as I've said over and over and over again, they know the playbook. And that's more important than anything. If you understand where we're ultimately going, then only in retrospect will those moves have been obvious. But to me, it is obvious because they know where it's going. And everything that they've done back at it, that they knew the playbook, whether it be Basel III or the reclassification of gold, or all of these decisions, even the new settlement currency and how gold must be held within the borders of the countries that possess it. So do you think there's any coincidence that all these banks not only are massively buying gold, but also repatriating it, just like India who bought 1.5 times the amount of gold in the first 4 months of this year than they did all of last year, which was a record year. It's because they know the playbook, and the BIS is center in telling everyone the secrets or giving them the playbook and saying, now make your maneuvers and do it quietly and do it as swiftly as possible, because there's going to be a change, whether it be reclassifying gold as tier one or issuing a new settlement currency in the BRICS nations. They know where it's going, and that's why you don't listen to what they say, maybe. Just watch what they do. Well, it's interesting because over the past 2.5 years, according to the official numbers, and we all know those official numbers are vastly understated, but the central banks of the world have purchased 1,250 metric tons of gold, which is worth about $80 billion. And when we talk about a government that by its own estimate will take another 22 trillion in debt over the coming decade just to keep the lights on, so to speak, to roll over the obligations that we have and to continue to fund our spending habits, well, that's an awful lot of money. And I'm sure that those are severe concerns. But think about this. In other words, if the central banks were to purchase, let's say, 5% gold right now in U.S. dollars, just converting 5% would be another 300 to 400 billion in purchases. Now, an $80 billion infusion pushed gold up to its all-time high. At the same time, we have a strong dollar, we have positive real yields, and outflows out of the ETFs. What happens if they just convert 5% of their dollar holdings? And it seems that this has been a trend that's been accelerating. Now, granted, that's $300 to $400 billion. That's 5 times what they bought over the last couple of years. But what I'm getting at is that as these central banks continue to de-dollarize, they realize that inflation has been chosen over austerity, the way that all governments have. What I'm trying to say to you is this: you add that kind of money, you're talking gold that could easily be up above $10,000, because 80 billion pushed it up here to 2,600 and change with virtually no U.S. participation. And I think that you are seeing and will see kind of like a hockey stick, right, where the acceleration in de-dollarization accentuates. And I really do believe that that's as crazy as it sounds to me, a conservative estimate. I can't imagine that all you would see is 5% of the $8 trillion in U.S. dollar holdings that these central banks hold around the globe would be converted to gold. I think that number will be much more. But 5% would be 300 to 400 billion injection into gold, and that's 5 to 6 times what they've already bought in the last 2.5 years, which has been the driving force behind the rise in gold. I don't know. I happen to, it's rocket fuel waiting to happen. I really, truly do. And this is a trend that has done nothing but accelerate. And that's what you see. Plus, we just lowered interest rates. And according to the World Gold Council, historically, every time we see a Fed cut, gold has rallied as much as 10% in the 6 months after the first Fed cut. So we just saw the first Fed cut. We're seeing increased central bank demand. And we're now beginning to see the ETF start to tick up. I mean, in terms of you try to lay out an argument for a bullish case for gold, I don't know their path. And that is one of inflation. And so when you talk about inflation, sanctioning, all of the things that these central banks are thinking of, not to mention the BRICS and their gold-backed settlement currency, which again has been reconfirmed that this indeed is real and will be discussed in the meeting here in the next 3 weeks in Russia. Yeah, I think we could see much higher prices over the next 6 to 12 months, especially as we are now banking another 50 basis point rate cut. At least that's what the smart money thinks will happen. So, yeah, in every metric, gold is at all-time highs. But maybe the flawed logic is that it should be a whole hell of a lot higher, that it's been suppressed for so long that these numbers that we are all awestruck over are really well short of the mark. just because it hasn't been able to reach its real price due to the massive shorting on both the LBMA and on COMEX. Maybe, just maybe, all of these other assets that have reached such stratospheric highs and gold and silver kind of painting a picture, allowing most people, including maybe even you and I, to sell short where gold and silver really ought to be and where it is ultimately going. And I think you can look at some of the traders at Goldman Sachs and at UBS who might echo that same sentiment. I'm sure we'll talk about that in a moment. Well, I'm going to read UBS first because it's not as grandiose as Goldman. They're close. But UBS says gold has risen by 29% this year, consistently breaking records on the way up. Meanwhile, the metal has risen above our long-held year-end target of $2,600 ahead of schedule. And according to the World Gold Council, as I mentioned to you, it has historically rallied as much as 10% in the first 6 months after a Fed cut. We now expect gold to reach $2,750 per ounce by the end of 2024 and to $2,900 per ounce by the third quarter of 25. And so that's pretty significant, but not as significant as Goldman Sachs, who is talking about right now in the fourth quarter of 2025, by the end of the third quarter in 2025, $3,000 gold. By the end of the year in 2025, $3,080 an ounce. And this is elevated from $2,700 to $2,900 an ounce. Again, these banks are coming out and saying, yeah, we're moving to $3,000 an ounce. And Goldman Sachs has said that they're being inundated with precious metals requests on their trading desks, which is a very, very, very big deal, obviously. And it is being evidenced by the first time in 2.5 years, we see an uptick in ETF holdings. And so as ETF holdings pick up, as the Fed pivots and lowers rates, probably another 50 basis points here in November, this is just rocket fuel for gold, which has done what it's done, again, rallying 29% and 47% since 2022 when we saw this divergence in 2022 where the ETF started to outflow in the U.S. and gold started to go up, really. And so this 47% gain since 2022, as the public has not been involved in it, with positive real yield and a strong dollar. Now you see dollar kind of hanging right at that 100 mark on the Dixie and could very well fall from there and drop a little bit or maybe a lot, of course. And then you see that the yields coming down and now the ETFs ticking up. This is all huge. And to see Goldman and UBS say these things is again, very, very significant. They're acquiescing to the reality that, again, you can only manipulate a market over an extended period of time, done again by pushing it in the direction that it is going. And that is the key, that maybe these banks realize it's as dumb as a mud wall, like Bank of America, to be naked short in a market where the rest of the world is voraciously accumulating metal, to the point where just in the month of August, 8.1% of all the silver held that's available for delivery and the LBMA was delivered, 8.1%, over 25 million ounces in the month of August. So it's accelerating the acquisition of gold. And it's also being done in a manner to not upset the apple cart, as we talked about last week, with 160 metric tons purchased by Saudi Arabia, but not disclosing it the way they're supposed to the IMF, because they don't want to upset the big kahuna, the United States. And yet they're playing both sides of this game. Ultimately, if you just put all of these things together and realize that the commercial banks and the central banks, who are the most collectively well-informed and well-financed traders in the world, are telling you where this is going. And if you don't pay attention to the Goldman Sachs report or the UBS report, where the hell do you find it, right? Where are you going to find it on the mainstream? Are you listening to the mainstream who isn't saying a word about any of this? It's not easy to find and read through these analyst reports for UBS and Goldman Sachs. It sucks reading it, to be honest with you. And they're 25 pages of a bunch of mumbo jumbo. And then they say, yeah, gold's going to 3,000 by the end of the year. But if you only relied upon, and you consider yourself very well read by reading the Wall Street Journal, watching Fox News, and paying close attention to the markets, you are missing this completely and totally. There is your massive contrarian indicator. Not only are the biggest boys in the world telling you, yeah, this is where it's going, but you can't find it unless you dig. I don't know. To me, it's a massive contrarian indicator, and I would say that's probably selling it short from where it ultimately goes.